The U.S. housing market is experiencing a seismic shift as unsold inventory piles up across the country, leaving homes vacant and unsold. According to recent data from Realtor.com, July saw an addition of 130,000 unsold homes to the U.S. housing inventory. This rise in unsold properties indicates a cooling housing market and potential price declines in certain regions. If you're in the market for a new home, you might be excited to learn which cities are seeing the most significant changes. Before diving into the details, make sure to like and subscribe for more in-depth housing market analysis. One of the most surprising developments is the growing inventory in cities like Nashville. As housing prices continue to adjust downward, Nashville is experiencing a rapid increase in available homes. But even Nashville's challenges pale in comparison to Las Vegas, which ranks as the 9th metro area with the highest inventory growth. In July alone, nearly 2,600 homes were added to Las Vegas' unsold inventory, a record high that is already impacting housing prices in the area. Realtor.com reports that over 65% of listings in Las Vegas now feature price cuts, signaling a shift towards a buyer's market. The accelerating housing market downturn is more rapid than many experts expected. Despite the growing inventory and falling prices, the industry remains surprised by the lack of buyers returning to the market. Fannie Mae's recent housing survey revealed that 75% of Americans believe now is the wrong time to buy a home, a stark contrast to the long-term average of just 5%. This sentiment, coupled with increased inventory, has led potential buyers to adopt a wait-and-see approach, anticipating even lower prices and more options in the future. This trend is visible in cities like Sacramento, where inventory has grown by a staggering 72% year-over-year. Sacramento's housing market is showing signs of significant decline, with inventory levels 40% higher than they were during the pandemic's peak. Housing prices in the area are already down, and further declines could be on the horizon. Seattle is another city facing steep challenges. The city's 30-year fixed mortgage rates have more than doubled, making homeownership increasingly unaffordable. A prospective buyer in Seattle today would need to allocate over $56,000 annually to cover mortgage payments and property taxes, a cost that has driven many potential homeowners out of the market. The rising costs and shrinking buyer pool are mirrored in other Pacific Northwest cities like Portland, where significant outmigration is compounding the housing market's woes. Home sales in Seattle have dropped by 7% year-over-year, underscoring the difficulties facing this once booming market. On the other side of the country, Tampa, Florida, is also grappling with a sharp inventory increase. Investors, who have historically played a significant role in Tampa's housing market, are now retreating, leaving behind a void in housing demand. Tampa's inventory levels have risen by 92% year-over-year, contributing to falling prices across the metro area. With investors pulling back, Tampa's housing market is undergoing a significant recalibration. This pattern of skyrocketing inventory and price reductions is not limited to a few cities. Austin, Texas, is seeing one of the most dramatic surges in available homes. In just 5 months, Austin's housing inventory has ballooned from 1,416 homes in February to nearly 8,000 in July. This increase has pushed inventory levels above pre-pandemic norms, creating downward pressure on prices. Some estimates suggest that Austin home prices have already fallen by as much as 20% over the summer, and further declines are anticipated as the market adjusts to the new reality. Foreclosures, while still near record lows, could become a significant factor in the coming months. As the recession deepens and overdue borrowers face increasing financial strain, the backlog of foreclosures may begin to hit the market. This influx of distressed properties will likely add to the growing inventory and further depress home prices. In our next video, we will discuss the anticipated wave of foreclosures and explore strategies for taking advantage of these opportunities, so make sure to subscribe and turn on notifications. Colorado is another state experiencing a sharp decline in housing market activity. Cities like Denver, Pueblo, and Colorado Springs have seen inventory levels soar by over 150% year-over-year. In Colorado Springs, the home price-to-earnings ratio has surged to one of the highest levels in the country. making properties increasingly unaffordable for local residents. This unsustainable growth has led to significant price corrections, with some experts predicting declines of up to 55% in certain areas. Phoenix, Arizona is another market to watch closely. Inventory in Phoenix has risen by 160% year over year, with over 60% of listings featuring price cuts. The market is being flooded with properties as Wall Street investors and landlords sell off their holdings. This mass exodus is creating what some are calling a housing market bloodbath, with prices expected to drop by 30% to 35% in the next 2 years. For prospective buyers, it's a market to approach with caution as further declines seem inevitable. Honorable mentions include Utah cities like Salt Lake City, Ogden, and Provo, where inventory has more than doubled, and Southwest Florida markets such as Naples, Hayti Coral, and Northport, which are also experiencing unprecedented inventory growth. These areas are seeing substantial price cuts as they navigate the current downturn. The impact of rising interest rates cannot be overstated. With mortgage rates climbing to their highest levels in decades, many potential buyers are priced out of the market. This trend has a cascading effect, leading to higher inventory and slower sales. In high-cost markets like San Francisco, Los Angeles, and New York City, these rising rates have significantly cooled demand, leaving properties sitting on the market for longer periods. In addition to interest rates, wage growth has not kept pace with the rising costs of homeownership. This disparity is particularly evident in cities like Denver and Austin, where housing costs have far outstripped median income levels. For many residents, homeownership is no longer a viable option, forcing them to rent or relocate to more affordable areas. One major aspect impacting the housing market's future is the role of institutional investors. These large-scale investors, who once drove up demand and prices, are now retreating from the market. Their exit is leaving a significant void, particularly in cities like Tampa and Phoenix, where investor activity was historically high. The pullback is not just a reflection of rising interest rates, but also of diminishing returns in an oversaturated market. This retreat is expected to continue influencing price trends and inventory levels over the next several quarters. Meanwhile, the construction industry is grappling with its own set of challenges. Builders are facing higher material costs and labor shortages, which are delaying projects and increasing the cost of new homes. In some regions, builders are offering significant incentives to attract buyers, including reduced prices, lower mortgage rates, and additional upgrades. However, these incentives are not enough to offset the broader economic pressures, which continue to weigh heavily on the market. The shifting demographics of home buyers are another important factor. Millennials, now the largest segment of the home buying population, are prioritizing affordability and flexibility. Many are opting for suburban or rural locations where they can find better value for their money. This shift is reshaping demand patterns and forcing sellers in urban markets to adjust their pricing strategies to attract this growing demographic. Finally, we arrive at the number one housing market facing the steepest challenges. This market's inventory has grown by 150% year over year, reaching its highest level since Realtor.com began tracking data in 2016. With over 3,700 homes actively listed as of July, the situation is a clear indicator of the housing crash's severity. For more detailed data and analysis, be sure to like this video and subscribe to our channel. Your support helps us continue to provide valuable insights into the housing market. Thank you for watching, and we'll see you in the next video. Stay tuned for our upcoming deep dive into the foreclosure wave and how to navigate the changing housing landscape.